Stop worrying about headlines. The economy is not as bad as you think. In fact, we are currently in a once-in-a-generation opportunity to build wealth. Now could be one of the easiest times to dramatically increase your net worth if you know what you're doing. After all, there's a famous saying that riches are made during recessions, and even though we're not in a recession right now, when the economy is down, it's actually a great time to get our money up. And to prove this, let's play devil's advocate. For the rest of this video, I'll speak as if we're actually headed towards a horrible recession, and I'll prove how you can still come out ahead. And if you watch until the end, I'll tell you about a unique strategy that can basically make you recession-proof. Let's get started. Generally, recessions are accompanied by a significant rise in unemployment, a drop in wages, a loss in consumer confidence, and a decline in values across everything from stocks, food, energy, and services. Sometimes with long-lasting effects throughout the entire world. Second, along with the recession usually comes a decline in earnings. Every quarter, companies report their revenue and large media companies begin to publish news on their future outlook. But lately, they've been cutting back, leading to slow or even negative growth and inciting recession risks at the highest levels since the Great Depression of 1929. All this leads us to layoffs. When consumers earn less, they spend less, and when companies see less demand, they begin to scale back on their expenses. The largest expense for most companies is their employees. This is especially common with tech companies which have low overhead costs because most of their assets are digital. For example, Meta laid off over 10,000 employees during signs of a severe recession in the upcoming year, and they're far from the only ones to do so. Just a quick Google search for mass layoffs will pop up dozens upon dozens of companies that are all cutting down their workforce. Recent reports indicate that while job growth remains positive, it is expected to slow down over the course of the year, with potential job losses in certain sectors. So in terms of what this means for you and your investments, as well as how you could use this information to make you money, let's start here with Number 1. Stocks. As of now, all three major indexes have experienced significant fluctuations, with some analysts predicting further potential declines. Historically, since 1946, the average bear market drop has been close to 30%, with the most severe being in 2009 when the S&P 500 fell 57% from its peak. Now, once you combine the average with the recession, bear markets tend to do even worse with an average drop of 34.8%. All of this is to say that generally, the absolute bottom occurs when we see capitulation across investors. Usually that's a time to start the recovery, and things begin to bounce back. But what if you could invest in companies that don't take a hit during recessions in the first place? You might be surprised to know that companies like this do exist, but they're not the sexy, overpriced tech companies like Nvidia that we're all obsessed with. I'm talking about boring bussiness that stand the test of time, such as energy or agricultural companies. After all, no matter what happens to the economy, there will be still demand for food and energy. This is how the smartest investors invest their money. They find low-risk and high-reward companies that can grow in the long term. But the problem for everyday investors like you and me is that these companies are had to find and require a lot of research. Sometimes it takes hundreds of hours just to find one. Lucky for you, I found a solution. I recently discovered a weekly newsletter where expert money managers analyze what's happening around the world and find amazing companies for you to invest in for the long term. For a limited time, you can try it for 30 days for just $1 using the link in the description below. Number 2. Real estate. Even though every area is different and some locations continue to flourish, housing declines on a national level are incredibly rare. In fact, as you can see throughout the last 60 years, there have only been a few times where prices meaningfully fell more than 10%. However, recent forecasts suggest that national housing prices might experience some declines, with some predicting a worst-case decline of 10 to 15% should interest rates continue to increase. Of course, every market is going to be different, and according to Moody's analytics, the most vulnerable markets could see upwards of a 25% decline from the peak. This includes parts of Florida, Arizona, Idaho, and Southern California, with the decline lasting another 12 to 18 months before bottoming out. Now, in the big picture, it's probably going to make a small difference for anybody with a fixed-rate mortgage who intends to stay in their property for another 5 to 10 years. But for anyone looking to invest or buy a house, we may begin to see some deals starting to come on the market, which we'll cover shortly. Because we have to also talk about number 3, cash. Clearly, up until now, there's been a mindset that cash is wasting away to inflation. But when every other asset is falling in price, sometimes cash could be the safest place to store your wealth. And when someone like the billionaire Ray Dalio admits that cash is no longer trash, you know there must be some truth to this. Many people forget that as recently as 2018, cash was the best performing asset. And if you had just been saving your money in a high-yield savings account, you would have far outpaced the market. Cash is now becoming such a significant part of the portfolio that even fund managers are holding on to the highest amount of cash since 2001. And Citigroup said that cash is the only asset that investors could use as a recession hedge. Now, viewers of my channel might call me out for being a hypocrite, because I've made several videos trashing cash as well, but allow me to explain my position. I personally believe that holding on to lots of cash is a bad idea in almost any economy, because investing will almost always give you a better ROI over the long term. This is backed by over 100 years of stock market data that you can find with a quick Google search. I also believe that it's a good idea to diversify your income across different asset classes to give yourself a fighting chance against a global depression. All this isn't to say that I think cash is trash and you shouldn't have any of it. I think it's a great idea to always have a small amount of cash on the sidelines in case of an emergency. Alright, so in terms of why this next recession could be a once-in-a-generation opportunity, just consider this. First, everything becomes less expensive. The way I see it, even though one person might think you're dumb for investing when everything is falling 30%, a wealthy person would see this as an opportunity to be able to buy those exact same companies for a 30% discount. Warren Buffett really had the perfect analogy for this. He said, "When hamburger prices go down in price, we sing. When hamburgers go up in price, we weep." For most people, it's the same thing with everything in life that they're buying, except for stocks. When stocks go down and you can get more for your money, people don't like them anymore. People should stop thinking of stocks like a gambler and start thinking about them as an intelligent investor, because a falling stock market could work to your advantage. Second, there's less competition. The fact is, when times are difficult, companies scale back, they fold, they conserve cash, and they play it safe. But this opens the door for smaller, more aggressive companies to stand out and take their place. For example, one study across 16,000 companies found that those who continue to advertise increased their value and got more bang for their buck with positive growth years after the recession ended. Third, there's way more opportunity. In a way, a recession is like natural selection. It weeds out the weak, the patient and analytical survive, and the foolish and desperate get wiped out. A wise investor made a fantastic comparison a few months ago that the peak of the market cycle is like a forest. Only the largest, most established trees or companies get access to all the resources, which, in this case, is sunlight. Everything at the bottom has a difficult time being able to compete, and it's hard to grow. But just like natural forest fires, our economy has a way of repeatedly clearing out and bankrupting the companies that are no longer able to sustain themselves, giving opportunities for newer, smaller businesses to continue to develop. Fourth, after every bear market comes a bull market. As Yahoo Finance points out, historically, the S&P 500 has fallen an average of 29% around recession with a median drop of 24%. But once stocks have bottomed out, their average return the following year is 40%, and within 2 years the market has increased an average of 58%. This means continuing to invest as stock prices go down is much more profitable than pulling out and trying to reinvest when prices start to go up. Long term, the market has always recovered after every single recession throughout history. And finally, on the fifth, you have to act before anyone else knows about it. I know it sounds easy to think, oh perfect, I'll just invest during a recession, but the truth is, recessions are never confirmed until much, much later. For example, the Great Recession that began in December of 2007 was not officially announced until December of 2008, only a few months before it officially ended. The recession before that began in March of 2001, but they didn't call it a recession until November later that year. And this trend continues with about a 6 to 12 month delay until we actually know we are in a confirmed recession. But in terms of what you could do about this to profit, number one, scale back your expenses. This means that you track your market, cut back on unnecessary spending, and operate lean while you continue reinvesting as much as possible back into the market. I would recommend investing in a broad market index fund such as the Vanguard S&P 500 Index Fund to reduce your risk. You should also have a plan on what you would do if your income were to drop 20 to 50%. For example, if you suddenly lose your job, How would you make up the difference, and what can you do ahead of time to protect yourself from this scenario? In a few minutes, I will share what I do to protect myself from a sudden decline in income and why you should consider doing the same. But for now, let's move on to number 2. Hold on to some cash. Now, I'm a firm believer that even though statistically your money is best off invested as soon as possible, there is something to be said about the peace of mind of having cash on the sidelines just in case things go south. For me, cash makes up anywhere between 5 and 10% of my portfolio, depending on the time of year. But generally, this has given me so many opportunities to jump on good deals when I find them, and it lets me sleep peacefully at night knowing that no matter what happens, I have cash in the bank to fall back on. Number 3, protect your income. This, at the end of the day, is going to be your best hedge against whatever happens. Financially, your worst-case scenario is not the market going down, but instead, it's the market going down at the same time that you lose your job and have to sell off your investments at the bottom before they have time to recover. This gets even worse if your job was your only source of income. I find it so strange how the same people who obsess over diversifying their investments never think about diversifying their source of income. Unless you have millions of dollars invested, you're probably still relying on your job to pay the bills. And if you lose your job, you either go into debt or sell your investments at a loss. Now is the best time to improve yourself, learn new skills, and add another source of income to protect yourself from financial troubles. And after that, number 4, invest long-term. The best course of action when it comes to investing is to simply carry on as usual and pretend like nothing's happening. It's been proven countless times that dollar-cost averaging, or the practice of buying into the markets on a regular basis, is the most profitable strategy. So, stay in the market and continue buying in. And number 5, diversify your investments. Now, if you can't personally handle a 20% drop without panicking, it's probably a sign that you're investing too aggressively. For instance, if you're completely in US tech stocks, then it's probably a good idea to add large caps and international stocks to the mix too, or potentially look into investing in real estate because people will always need a place to live in. The more legs your portfolio has to stand on, the less likely it's going to collapse should one or two of them break. So in general, this is also a great time to double down on your work and learn as much as you can. And speaking of learning, if you want to learn how to make real money with the stock market, click the link in the description.